Ladies and gentlemen, if I can have your attention, we're going to try to go ahead and start. We got to find a projector and go through some hoops and things to jump through here. I think we're going to get started. First of all, I'm standing in for my chairman, Chairman Larry O'Neill can't be here right now. Hopefully he'll be here a little bit later. I'm Vice Chairman of Ways and Means. I want to welcome everybody here for our meeting, and I'm going to turn it over to the upper side over here with Senator Chip Rogers and the Senate Finance.
Thank you for that eloquent introduction. We are, first of all, glad everyone is here today. A very important topic and some important guests that have joined us today. I think you'll find their presentation quite interesting as we look towards perhaps radically changing Georgia's tax code, or maybe just marginally changing Georgia's tax code, but it is something that is under consideration. And the group we have asked to join us today is the Tax Foundation. This is a nonpartisan group who studies tax policy, not just for the nation, but the individual states as well. And they have worked with a number of states in refining their tax system to become more competitive. And certainly we want to consider doing that ourselves. They have produced some facts and figures and some analysis of not only where Georgia stands, but where some of our neighbors stand and where we might go in the future as we look at different tax policies. So with that, I would like to introduce two gentlemen. First, I believe, is Jonathan Williams. He's a staff economist at the Tax Foundation, and he conducts policy research on energy tax policy, state tax competition, and corporate taxation. And with him today as well is staff attorney Chris Atkins at the Tax Foundation, who specializes in analyzing federal, state, and international tax policy. So with that, we'll turn it over to Jonathan.
Thank you, Mr. Chairman and members of the committee. It's an honor and a privilege for us to be with you today and share with you the research that we've been conducting on Georgia's tax system. Just a little bit about the Tax Foundation. As Senator Rogers mentioned earlier, we are a nonprofit, nonpartisan think tank based in Washington, D.C. We were founded in 1937 because we view it in the interest of good information to distribute and disseminate information on tax policy for lawmakers such as yourselves and for average citizens. And we're here today not because we have a political axe to grind or because we have a dog in this fight, but we're here just to give you facts and where you rank competitively and how your tax system does in comparison to your neighbors and to the nation as a whole. And we're here because we feel that Georgia has a tremendous opportunity to see fundamental tax reform in the near future. There are a few ways that we analyze state tax systems when we sit down and go out to the states and do presentations like this. And while there's no ideal mix of taxes, there are several ways we can benchmark tax systems and evaluate them competitively. One of these ways is based on our principles of sound tax policy. And these are neutrality, simplicity, transparency, and pro-growth. Neutrality, a tax system should not be in the business of picking winners and losers. It should strive to create a system where all taxpayers are treated equally. Tax systems should also be as simple as possible and reduce compliance burdens for individuals and businesses. Another must is transparency, in that a tax system should be visible to the taxpayer and that people should understand how they're being taxed. And finally, a tax system should be pro-growth because it should not in any way interfere with economic growth and development. There are a couple models that we look to in the states that do well as far as in terms of tax competition. One of these models is if a state were to do without a major tax, like a statewide income tax or a sales tax, and these states do well competitively. And there are many states that do without such a tax, such as your neighbor to the south, Florida, that we view as one of the most competitive tax systems in the United States. Also, if a state does not do without a major tax, there's still room for hope in that there are states such as Colorado that have all major taxes, but yet levy that tax on a broad base and with low rates, and still can be competitive. When we talk about tax burdens, basically what we're saying is how much of income is consumed by government and with taxes. And burden data is very useful in that it provides good comparison among states, and state tax structures have vary widely. But unfortunately, burden data is somewhat limited as well, and because it doesn't offer specific guidance for lawmakers such as yourself. If you deem that your burden is too high, it doesn't give you specific suggestions for pro-growth reform, and that's why the other side of the equation is tax structure, and that's basically looking at how the government goes about collecting this revenue. Just a little bit about how we do our tax burden estimates versus some data that you might see from the Census Bureau and their tax collections. One thing that differentiates our data and makes it more complete is that we include both state and local tax burdens. And to get a real clear view of economic reality, it's important that we both look at state and local tax systems. And also, the Census Bureau takes just a look at collections and doesn't take a look at the economic incidence with taxes. And that we'll give you an example as far as Wyoming, for instance. Wyoming collects a tremendous amount of taxes because its vast natural resources. But it's pure economic folly to believe that Wyoming is a high tax state, even though these businesses are paying the taxes in the state. And that has to do a lot with the fact that the residents of Wyoming do not pay these taxes, but all energy consumers across the country do. And it's more in line with economic reality to allocate the tax burden across those users. So you probably are asking the question, so you go out to these states and evaluate taxes, how does Georgia compare both regionally and nationally? In 2006, Georgia has the 25th highest tax burden, so they're right in the middle nationally in terms of burden. But if you look at it in a regional context, I think it's much more telling in that the southeast region is by and large a low tax region, and that means that even though Georgia's tax burden is mediocre, middle of the pack nationally, it's the second highest in the southeast region. Another thing I looked at was historically how Georgia has moved with this tax burden. We started looking at state and local tax burdens, and we have that available on our website from 1970 to the present. And in 1970, Georgia was a low-tax state. But over the years, over those 36 years, Georgia's tax burden as a percentage of income has grown 20% and has really moved up. A couple things when we look at tax structures. I mentioned it's a two-sided coin. It's a double-sided equation. One side burdens and one side structures. A tool that we use to analyze tax structures is the State Business Tax Climate Index, which we created as a tool for lawmakers to make their tax systems more competitive in the regional, national, and international marketplace. And what we do is we base it on 5 different areas. We look at corporate taxation, direct taxes on corporations. We look at individual income taxes. We look at sales taxes, unemployment insurance taxes, and taxes on wealth, such as capital stock taxes, franchise taxes. And we view this as important because taxes do matter to business. Taxes are something that affect every business's bottom line. And to all the business owners and people that operate under that, they can tell you that taxes are indeed important to business investment. We did a study that looked at the top 10 states in our State Business Tax Climate Index versus the bottom 10 states, and looked how they performed economically in various different factors: population growth, economic growth, personal income growth. And we found that the top 10 states in the index, the most competitive tax climates, ranked much better in those forms of economic growth than the bottom 10 states. Another thing to keep in mind is that tax changes are not done in a vacuum. They're not created in a vacuum. So every time that a state changes their tax system, it affects their competitive position relative to the bordering states and states throughout the United States. Now, we agree that there are many factors that come into play with business investment decisions. Roads are important. Education is important. A good legal system is important. But there's a couple major reasons why taxes should be the most important out of those. One of these reasons is that taxes are one thing that, as lawmakers, you can immediately change. And another thing, as I mentioned before, is that taxes are the only out of that list that affect a business's bottom line. And so you can have a well-educated workforce, you can have great roads, but if you have a poor business tax climate, a well-educated workforce is going to go to other states to look for employment. Just to give you a little snapshot on where Georgia ranks in the 2007 State Business Tax Climate Index, overall, Georgia ranks 19th out of 50th, so slightly above average. On the corporate tax index and the sales tax index, Georgia does quite well, basically because with the corporate tax system, the single flat rate and a fairly broad base. And with sales taxes, it ranks well because of the low 4% statewide rate, and many business-to-business transactions are exempt. Sure. Overall in the index, Georgia ranks indeed 19th out of 50. In the corporate tax index, Georgia ranks 6th out of 50th. Individual income taxes, Georgia ranks 22nd. Sales taxes, Georgia ranks 7th. And property taxes, Georgia ranks 23rd. And to take a look with the corporate tax system, with Georgia's 6% rate, when you add that to the federal statutory rate of 35%, a company looking to start up in Georgia is looking at a 41% statutory corporate tax rate. And to put that in proper comparison, if you look at countries across the world, a company trying to start in Georgia today is going to face a higher corporate tax rate than one that would want to start in countries such as France or Sweden, for instance. So it's imperative that we take a hard look at the way that the corporate tax works for competitive purposes. And as far as individual rate goes, Georgia's 6% rate is in the middle of the pack regionally, with North Carolina having the high at 8.25. But it's interesting to note that there's little room for error, since both the neighbor to the north, Tennessee, and the neighbor to the south, Florida, have no personal income taxes. And so to be competitive with them, there would have to be large steps taken at that level. And then we took a look at sales taxes as well, and Georgia does quite well with the sales tax with the 4% state rate, and then a weighted average of local sales tax rate puts the total average sales tax in Georgia at 5.1%, and that is the lowest in the region. And that's primarily why Georgia ranks well in our sales tax index. And then I also went through and looked at property tax, the property tax collections as a percentage of income, and Georgia is at 2.5% of personal income, which puts it third highest in the region, behind South Carolina and Florida. And as I mentioned before, we talked a little bit about capital stock taxes. Georgia's capital stock tax rate at 0.023 is the lowest of the states in the region that have a capital stock tax. Now, Florida does not have any capital stock tax, Capital stock taxes are basically a relic of the past. They're something that were instituted in states during the 20th century, and by and large we've seen movement in the states to repeal those taxes. They're just an added layer of complexity and tax burden on companies that already have to comply with the corporate income tax. So at this point, I would like to turn the presentation over to my colleague, Chris Atkins, who has been working on state tax issues for many years, and will provide his thoughts on this. Thank you very much for the chance to be here.
Thank you, Mr. Chairman. Thanks for having us down to talk about tax policy today. Jonathan has laid the factual foundation that you need to determine whether you're going to embark on fundamental tax reform. Just to summarize his presentation, it really is, our findings are that on tax burden, that is how much you collect, Georgia's middle of the pack, average, 25th out of 50 states. On how you collect it, the tax structure, the system of laws, rules, and regulations that you have on the books to collect that tax burden, you're slightly above average, 19th. So, given those facts, if you're going to embark on fundamental tax reform, what are the next steps? Well, I think the next steps, you have to get them right, because we're seeing some states try to do this, and they're getting the fundamentals wrong, and it's impacting the policy debate in a negative way. Let me give you one example of a group of lawmakers, much like yourselves, that are meeting right now determining what to do in the future, and that's the state of Michigan. Michigan has a single business tax, the SBT for short. It's widely considered to be an onerous tax, a tax that extracts a heavy tax burden on businesses and the workers, consumers, and investors in those businesses. So there's been fairly bipartisan consensus that it needs to be changed and it needs to go. So both sides came together and said, okay, what are going to be our policy principles for replacing this tax? And one of the strictures that was placed on the debate is that we can't shift the business tax burden from businesses to individuals. And as I'll explain in a minute, businesses don't pay taxes. And businesses are at best hidden taxes on consumers, employees, or investors in a corporation or a business. And so by starting the debate with that fundamental principle, we're seeing a lot of bad ideas come out that violate many of the sound tax policy principles that we've laid out today, such as simplicity, transparency, stability, neutrality, and pro-growth. And you all may not agree with those principles. You may substitute some different principles in there. But it is important to lay out some principles that you're going to sift proposals through and ideas through before you get started. Otherwise, it's just an exercise in politics. Who can get the best deal? And then we have to come back in a year or two and talk to you again. It's great to be down here, of course. But you want to get it right, and you can get it right by basing your decisions on sound policy. Jonathan mentioned a little bit about understanding the differences between tax burden and tax structure. If you're a pro-growth-minded lawmaker, if you want the tax system to promote economic growth the best it can, you can't just be concerned with how much you collect. You have to be concerned with how you're collecting it. There are tax systems that are better from an economic perspective than others. If we had a PowerPoint, we could show you an example of two states that extract the identical tax burden from a business. But one does it through tax incentives and credits that are much more complicated, that you have to hire accountants and lawyers to understand and comply with. The other just does it through a broad-based low-rate tax. Even though they both extract the same tax burden, the simpler flat-rate system is much more conducive to economic growth in the state. I mean, I think we'd all rather be employing our resources producing real goods and services rather than employing accountants and lawyers to figure out the tax system. So there's a real economic cost to a complicated tax system. And I think it would behoove you to really focus on that economic cost just as much as you focus on the tax burden itself. And so I would really encourage you to understand and to explore the differences between tax burden and tax structure. Next, and I already mentioned this, people pay taxes. Fundamental tax reform will probably involve some type of study of the business tax burden in Georgia, the business tax system in Georgia. And it's important to understand that businesses are at best a conduit of the tax burden to individuals, and businesses don't themselves actually pay taxes. Recent research has indicated that the incidence of business taxation could fall very heavily on wage earners. And what that means is that when a business has to pay taxes, then it's going to, in turn, pay less in wages and salaries and benefits to the workers of that business. And so if you want to have competitive wages and competitive personal income growth in Georgia, I think we really need to come to the understanding that the businesses are passing those costs on in one way or another. Next, and I don't think this has come up too much in Georgia, but I do want to mention it as a foundational principle, although really it's an offshoot of getting the principles wrong. Gross receipts taxes are taxes on business that pretty much just apply to the gross sales of a business with no offsetting deductions for business expenses. A good neutral corporate tax system would apply to income, which is defined as sales minus costs. And states are moving more towards gross receipts taxes. Ohio did a few years ago, Texas last year. Michigan's even looking at a gross receipts tax to replace their single business tax. And I would urge extreme caution when looking at those types of taxes. We have 2 studies that have come out in the last 3 months that look at the severe economic flaws with gross receipts taxes. And I would just refer you to our website or give me a call or an email, and I can put those studies in your hands. And then finally, have to realize other states are moving. Michigan's having a debate right now about tax reform. A number of other states are as well. Arkansas and Idaho are looking at changes in their sales tax. Indiana is looking at property tax relief along with a number of other states. That's a very hot topic right now, is some type of property tax relief. In Kansas, the Democrat governor in Kansas has proposed a partial reduction in the corporate franchise tax and a reduction in the corporate income tax rates. Kentucky, there's movement afoot to eliminate their new alternative gross receipts tax because businesses and those who have to comply with it aren't liking complying with it. Even though they just instituted it 2 or 3 years ago, they're looking at getting rid of it. Michigan, of course, there's hope that Michigan could get it right and they could put a very competitive pro-growth business tax system in place. Nebraska, the governor there has proposed individual income tax rate reductions. South Carolina, perennially, the governor there proposes a long-term income tax elimination. In Texas, they're looking at reducing their new business tax. In Utah, they moved to an optional flat tax system last year. Rhode Island also did that. Basically, you have the option of paying a lower broad-based flat income tax or taking all the special credits and deductions. They're looking at expanding that in Utah this year. And in West Virginia, the Democrat governor there has instituted or has embarked on a journey to reform their business tax system. So we're starting to develop a bipartisan consensus at the state level that states need to do something about the competitiveness of their business tax and their overall tax systems. Part of that is, of course, as Jonathan mentioned, they're saddled with a very high federal corporate income tax rate for corporations who are looking to invest in their state, and that's probably something that lawmakers need to talk to the federal government about. But it is a reality, and you're not making changes in a vacuum. So, what should you do? One of the things we often hear when we go to states and talk is, well, you shot a lot of things down, but can you give us something real to put in its place? And so, here are my recommendations to you based on our research, which is our rankings of tax burden and tax structure. My first recommendation is, do you want to do fundamental reform or do you want to do incremental reform? Do you want to be in the top 10? Do you want to be one of the best tax states for business investment, or are you content with your current position, just want to tinker at the edges and sort of stay where you are? The answer to that question will impact the reform plans that you debate this year and that you put in place. If you're going to do incremental reform, here are some things I would suggest. Take a look at your corporate franchise tax. As Jonathan mentioned, it's a very low rate. It's capped at $5,000 liability per taxpayer. I don't know how much it raises in revenue, but I expect it's not very much. States are moving to eliminate this tax simply because it's duplicative. If you have a corporate income tax, you don't also need a net worth tax, and it's low-hanging fruit for states looking to make changes. Other property tax relief. Your worst rankings in our index are on property tax, so that's probably a natural place to look, either if you want to change your structure or reduce your burden. So take a look there. Even though you do fairly well in exempting business-to-business transactions from your sales tax, which, by the way, is an idea economists on the left and the right agree on, that businesses shouldn't pay sales taxes on their inputs, you currently tax many utility purchases, such as energy, for use in manufacturing or other types of business. I think that would be a good idea. I know that's been floated a bit in some of the news reports. And then possibly flattening out your individual income tax would help in our rankings as well. If you're going to do fundamental reform, if you want to be a top state, if you want to be a Florida or a Texas in terms of your business tax structure, you got to look at eliminating a major tax. The states that do the best in our tax structure rankings are those that go without one of the major taxes, except a caveat: you don't want to do it the way Tennessee does it. They don't have an income tax, which is good from a competitive perspective, an individual income tax. They do have a corporate income tax. But they're putting a lot of stress on their sales tax. If you combine their state rate and their local rate, it's about 10.5% on average in each locality. That puts a lot of stress on one individual component of the tax system, especially hard, I think, for some of your border counties. So just a caveat there. Of course, a lot of that is how much do you want to spend, and if you want to spend more and you can't have an income tax for political reasons, then you got to put that stress somewhere. So just a caveat on that. Burden or structure, you're good on burden, 25th. You're a little bit better on structure, 19th. So if you want to, it seems like if you want to go for anything, it would be to try to improve your burden ranking a bit, which would mean tax reduction. But that's a decision that you have to make. But you do rank a little bit poorer on how much you collect as opposed to how you collect it. Although, if you want to choose your burden, or if you want to reduce your burden, please choose the right taxes. We think the best way to reduce your tax burden is to do it in a broad-based way, in a fair way that applies to all people. The best way is not through special credits or deductions, which really is just the government picking the winners and losers in the marketplace. And there are a host of economic consequences from that those of you who want to support pro-growth policy would normally be concerned about. But when it comes to picking how you're going to reduce the burden, sometimes we forget about that. In conclusion, again, there is room for improvement, we think, in terms of your rankings. It is a historic opportunity, but you got to lay the right foundation. You really have to have some principles that guide how you're going to do this. We're happy to help. We were in Michigan last week. We're going to be in Kansas in a few weeks. We do work with lawmakers and staffers in many different states on these types of issues, helping you understand where you rank and which taxes are the right taxes to reduce, eliminate, or put more stress on. So we'd be happy to help. We're very thankful that you had us down today.
Thank you.
Mm-hmm. Start a question, if you don't mind. You alluded to the fact that there's a direct link between the business tax climate and positive growth of population.
Mm-hmm.
And, in other words, the top 10 business tax climate do well, the bottom 10 don't do well. As I look at the component indices that make up the business tax climate, is any one of them weighted more than another one? Is the corporate income tax more important than
Yes.
employment tax?
Yes. You have to remember this is a competitive index. So how we weight it is if, like, say, the corporate income tax area, if more states are grouped together, if their tax rates are very close, then we put less weight on that than if they're dispersed and there's more discrepancy between the states. And we explain in our index how we do this weighting. It's a bit technical as to why we do it that way, but since it's competitive, we think those areas where the differences are greater are where states are getting more of a competitive advantage. And so we will put different weights on the sub-indexes based on the spread of each tax rate and tax-based measure across the data points.
Thank you very much. This is directed to either one of y'all. I'm sort of curious about how you calculate the weighted average of local sales tax rates. You guys done it 1.1%, which I find to be a little bit difficult to believe for this reason. The four largest counties in the state have anywhere between 3 to 4% sales tax add-on for local options. My particular area of Atlanta, for instance, has 4%. And we're paying a total of 8%. So I'm kind of curious on the definition here on how did you come up with the weighted average local sales tax. So it seems to me counterintuitive given the fact that the four largest counties in the state have anywhere between 2 to 4%.
Yeah. I wish my co-author of the index was here with me. He's another staff economist, and he deals with the weighting of the averages, and he would be better able to answer your question.
Is this based on looking cross state countywide and all 159 counties, for instance, and then just sort of weighting that, or do you base it on actual tax revenue collected?
No, I believe we look at all the rates and then weight the average probably based on population along those lines. But please let me get in touch with you personally, and he will be able to. I'm sorry I can't answer your question personally. Okay. Okay. Yeah, it's a bit of a conundrum what you do because, I mean, the local is an issue for businesses where they're going to pay tax, and they probably have more of a choice of choosing which locality they're going to locate in than which state, to be frank. And so it is an issue, and we try to be fair about balancing the metropolitan areas, which tend to be the areas where businesses will look at more, with the other areas where the tax rates sometimes tend to be lower.
Thank you. When you rank taxes, similar to what Representative Lindsay was mentioning, when you look within a state, for example, within Georgia, we have a wide variation with respect to many taxes, not just sales tax, but there are other local taxes, for example, franchise taxes. Do you find that it's generally better for the business climate if within a state there's more consistency? So, for example, caps throughout, because that's the only way to manage it, or do you look at that?
We have one measure in our index that measures that, and that's whether states allow localities to define the sales tax base. And we will rank those states higher that do not do that, simply from a uniformity perspective. A new business looking to locate there or making sales in that state or locality faces an extreme compliance burden if localities are all allowed to define their own sales tax base, especially since the sales tax is destination-based. Well, property taxes, we just include, property taxes is tough to get data on, and it's a huge gold mine for researchers. What we do is we use per capita property tax collections and those collections as a percentage of income to calculate a tax burden and then rank states accordingly. And so that would include state and local. Many states don't have statewide property taxes, but it's mostly local. It's just an indication of if you're a business and you're going to locate in Georgia, what's the average property tax burden that you're going to face no matter where you locate. Sure. Yeah. There's a huge market for states to do their own local indexes on studying that type of variation and how it may impact business development.
Yes. Do you see any tendency for attacking the services? You hear about Florida every now and then, CPAs, lawyers, newspapers. Is that on the table then?
Yeah, it's on the table in Michigan, and we actually think it's a good idea. A sales tax should apply broadly to all consumer consumption, whether it's a good or service. If the sales tax just applies to goods, then all else being equal, you've made the service industry better off, no matter what type of service industry you're in. And so, with all respect to our friends in the service industry, we think they should be collecting sales tax on their services as well. And there's a huge opportunity to lower the rate when you broaden the base. Of course, the only caveat is that a lot of businesses purchase services too, and you don't want to apply the sales tax to business purchases of services. There's an easy way to do that, and we're going to get into that later this year, probably in a separate report about business-to-business transactions.
For another 5 years, assuming that the state tax doesn't change, y'all evaluate the state tax? We're a sponge state, so we don't have a state tax probably until 2011.
Right.
Would that be included in your analysis? That might kick back in 2011?
We just compare what your tax system was as of July 1, 2006. So right now you copy the federal system, which means you don't have an estate tax. If that changes, there's going to be a whole political calculus that has to happen in the states in 2011 if the federal government doesn't eventually completely repeal it. And we will note that in our index. I imagine the first index will have every state doing it again. But as states move to completely eliminate it, we'll reflect that too.
Thank you. Particularly interested in the first chart on the burden, where we were ranked 10.4% in 2006. Is there any consideration in your calculations for things like population growth, income growth, other sources of revenue? We get over half of our revenue from personal income taxes.
Sure.
So how do we compare it with other states?
We haven't looked at that specifically. This is just the tax burden, which means all taxes collected at the state and local level. It doesn't include things like fees, because the census we start with our calculations with the census, their tax collections. They don't include fees in that. So as you can imagine, fees are getting very popular for lawmakers to raise for that reason. But we don't, and we didn't. We'll go back, and it would be a good thing to go back and look and see how population and personal income growth have grown over the same time.